Hi Fools, I'm David Williamson and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. Let's go right into what healthcare stocks are winning today, and our first winner is Seattle. The Seahawks just won the Super Bowl, and now their namesake Biotech, Seattle Genetics, just won its fourth quarter. It reported $67 million in revenue, which is $8 million better than estimates, and narrowed its loss to 13 cents versus an expected 24 cents per share. Shares are up over 15% on the news. What I don't really love, though, about this earnings report is 2014 Seattle Genetics projected etc. sales of $160 million, with another $60 million or so coming in licensing revenue, which means etc. isn't really going to be the blockbuster product a lot of people were hoping it could be. The future of Seattle Genetics lays in its pipeline of ADCs and its bevy of licensed products, and not in its approved drug, but in many ways that makes it just like a lot of other biotechs out there, and it does have a very strong pipeline, and its partnership deals show that Big Pharma is interested in what it's working on. So moving on, we welcome another biotech IPO today on board with Flexion. Shares of Flexion are up nearly 15% on its debut, so congratulations are due. Let's take a look at Flexion's pipeline. And lo and behold, what is that? Is that a phase 2 drug candidate? I've gotten kind of numb to the amount of companies that are IPOing these days with little more than concepts and ideas, so it's refreshing to see a stock with a mid-stage drug. Flexion's drug is going to be a first-in-class injectable. It is sustained release. It will be injected into the joint, and it's a steroid treatment for patients with moderate to severe osteoarthritis pain. So Flexion, welcome to the publicly traded exchanges, and we'll be following your drug's development closely. We should also welcome Eagle Pharmaceuticals, which is our final winner today. It also IPO'd, although it isn't seeing the same strong gains as Flexion. Shares are trading about flat. It did manage to raise $50 million, giving it a market cap over $200 million. So let's go to Eagle's pipeline and see what they have, which is, what's that? A website under construction? They don't even have a website. They raised $50 million and they do not even have a website. Although they do have a pretty sweet eagle in the corner there. I don't know if you could see that. Heather, you may want to put the slide back up real fast just so our viewers can see that sweet little eagle. It's flying in the correct direction, up and to the right, which is I think where investors hope shares will go. Hopefully Eagle spends some of their newfound gains into building a functioning website. Also on their regulatory filing, I dug in and found their S1. They did want to assure investors that they won't need to raise money until sometime into the middle of next year. So yeah, look forward to that. I'm going to make the call right here. We're in a biotech bubble. I probably should have made it a few weeks ago when there were preclinical companies being valued over $500 million, but I'm honestly more offended by a company that raised $50 million, just a fraction of that, but was too lazy to build a website ahead of time. So that's it. I think we are now officially in a biotech bubble. All right, so let's move on to our losers today. Our first loser, our biggest loser, is Galena, which is down 15% as Adam Feuerstein over TheStreet.com is reporting that Galena is involved in a pump and dump scheme. Galena allegedly paid a company $50,000 whose promotion helped share prices triple in less than a year, and insiders have allegedly been selling into those gains. We'll see how this turns out, but it is a story we're going to be paying attention here over at Fool.com. Now, a company that is down on earnings is WellCare. It reported some pretty bad quarterly results. Shares are being punished 10%. Earnings fell to $1.09 per share from $1.32 last year. Analysts expected $1.15, so it was a pretty sizable miss, and no one really expected this decline in profit for 2013. Management, for its part, is blaming Obamacare. They're saying fees from the Affordable Care Act will lop off between $1.17 and $1.26 per share. The CEO is saying, the whole industry faces significant challenges. It did note funding pressure on Medicare Advantage, which is actually something all of the big insurers have been warning about. We've seen Cigna, Humana, Aetna, United Health come out, and there are concerns that funding cuts will be, instead of in the 2 to 3% range, more in the 6% range. So we'll see. That's something that's definitely going to impact the insurance industry stocks. I think they've actually been under a little pressure just because of all these advanced warnings, and maybe it's been a little too bearish. So we could actually see a pop if the cuts are 5%. Which is still more than they were estimated to be just a couple months ago, but not as bad as some are painting the picture to be. And sticking with Obamacare, let's move on to our what seems to be daily Obamacare segment. And it looks like Obamacare has a hidden tax in it, or at least a tax that not a lot of people were paying attention to. It's totals $150 billion over a decade. Now, this tax is targeted at for-profit insurers. It was designed for them. People in Congress were saying when they wrote the law to pay their fair share because they were getting all these new customers thanks to a Medicaid expansion. And these were seen as free customers, and so the for-profit insurers should have to pay some sort of tax for them. However, it looks like it's not quite playing out exactly that way. This tax would, if it were shifted directly to the consumer, would cause a premium expansion in the several $100 range. And it looks like the insurers don't expect to take that burden themselves because, unfortunately, they can't expense it. So it would have a pretty significant impact on earnings. They're doing door number 3, which is shift the burden to the state, and it looks like WellPoint and United Health have been largely successful so far, shifting this burden to the states, where the states will pay the difference. But it is something to watch going forward. I mentioned the Medicare Advantage cuts in the prior segment. The large insurers are really where a lot of policy decisions that happen in Washington impact their underlying businesses. So it's really critical to have a grasp of those if you're investing in these stocks. And we have between the Medicare Advantage and how well the large insurers can move this $150 billion tax onto the states. This will largely impact how these stocks perform over the coming years. So stay tuned there. And one other thing to stay tuned to as we move into our watch list segment is on Friday, Chelsea Therapeutics has a very important date with the FDA. Northera has its PDUFA date, its PDUFA date. This is an NOH drug. It treats dizziness and fainting with people in diseases like Parkinson's. The FDA has been always pretty skeptical about Northera. It was in its briefing documents yet again about the durability of efficacy. They did, however, Chelsea did manage to get an incredibly positive advisory committee vote, which was 16-1 in favor of approval. However, this isn't its first positive advisory committee vote. It did previously garner one, and the FDA rejected it, reminding investors that the FDA always has last say on these things. This drug has been available in Japan for decades, so it's not like it's something new. It is clearly pretty safe. But the durability of efficacy concerns remain. I'm not really sure which way this one will go. I think it's going to be a tough decision for the FDA. If it gets rejected again, I don't know how much more Chelsea can do to get this drug approved here, considering how long it's been available overseas and their previous rejection despite a positive AdCom vote. So I'm really watching this one closely. It's going to be really fascinating to me which way the FDA goes on this, and I suggest all investors stay tuned for that because Chelsea's stock is sure to move on Friday. Thanks for watching. Stay tuned to Fool.com for all your healthcare news, and Fool on.